Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why Advanced Micro Devices suffered its worst stock decline in nearly 9 years.
Plus, to look at why PayPal shares experienced the biggest intraday drop in more than 4 years.
But first, we begin with some news at the media and entertainment giant Walt Disney.
And that's because Disney announced Josh D'Amaro will succeed Bob Iger as CEO.
D'Amaro, a 28-year veteran of Disney, was chosen from among several internal candidates to lead the company at a critical time as it transitions from traditional TV viewing to the streaming era.
Iger will stay on the board and serve as a senior advisor until he retires on December 31st. We were joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
We first asked Geetha about the succession plan and how it might differ from previous plans.
Yeah, I think it was a very different time. March 2020, everything closes down, including, Disney parks because of the pandemic. So it was kind of unfortunate. The timing was all wrong, I would say, for Bob Chapek. And what happened then is, of course, movies were shut down. A big part of Disney's business, movies as well as the parks again. But then what really kind of shot into prominence at that point was the streaming business, a business that Bob Chapek was not really very familiar with. And while he did have some experience in content, obviously it was not enough. And we had a whole bunch of different missteps with the content part of the business, which kind of led to the whole, mess that we saw, follow. I think this time we're in a very, very different position. I think at that point, Disney was still kind of trying to figure out what it really was. Was it a TV company? Was it a studio? Was it a theme park company? Or was it really a streaming player? And I think now the pieces have kind of fallen in place. We are on much more steady ground, I would say. They have their clear mandates, whether it is in streaming, whether it's in studio. The clear, what has really emerged clearly right now, Scarlet, is that parks is the main core growth engine of the company. And I think that is reflected in this choice with Josh D'Amaro.
So, Geetha, Josh is a 28-year veteran of Disney, running the parks. But of course, the other big part of the company is its, entertainment business. Dana Walden, who runs the big part of that business, great reputation in Hollywood. It's important to keep her at the Walt Disney Company. Are they going to be able to do that?
I absolutely think so. So, this was a very clever move by the board to kind of create this new role for Dana Walden, make her the president and the chief creative officer. They've never had this post before, but they specifically created this one for Dana Walden. So that, I think, really kind of, dispels a lot of fears about what would happen from a creative perspective. Last time, this was the same problem that, many investors raised when Bob Chapek became CEO. So having her there in the creative role, I think definitely plays very well with Hollywood, with the creative community, and ensures that, Disney will still have a top tier content coming to its streaming platforms for the foreseeable future.
So Josh D'Amaro takes the job on March 18th. That's when the succession is effective. And we talked about how yesterday Disney came out with a forecast that was fairly tepid. And one way of looking at that is it kind of, clears the deck, lets him start off with a clean slate and set expectations and kind of manage it for investors the way that he sees fit. At what point does he own everything that happens to Disney?
So actually, a lot of the things that we're seeing right now with the parks has been under Josh D'Amaro's watch. Remember, once Bob Chapek was promoted to the CEO position, Josh D'Amaro assumed the role of chief of the parks. And so all of the different initiatives that we've seen, whether it's Lightning Lane, whether it's Genie, whether it's the $60 billion expansion, a lot of that has been, Josh D'Amaro's doing. I mean, of course, I think the street is definitely going to give him a few quarters to kind of settle in. But he has pretty much been the architect, along with Bob Iger, I'm sure, and the rest of the management team, in kind of instituting the strategy and making the parks a prominent part of the portfolio going forward. So very soon, the short answer, Scarlet, is very soon. I think he owns pretty much all of this right away, in fact.
Geetha, if I were Josh tomorrow, day one of my tenure as CEO, I would go and I would say, hey, explain to me why we are not spinning out our broadcast and cable networks. They are businesses that are in a secular decline. They're dragging down our multiple. Let's cut them loose. Do you think that's even an option for the Walt Disney Company?
I think it is. I think everybody is considering that right now. I mean, we've just seen what Warner Brothers Discovery has been able to achieve by kind of separating out its studio and streaming from the TV networks business. So I definitely would not rule that out. I'm sure Disney will consider, and Josh tomorrow will consider all options once he becomes CEO.
What happens to Jimmy Pitaro over at ESPN? Does that become part of the spin out as Paul was talking about it? Because there's different parts of Disney's media business that are slowing down, that are no longer the crown jewels the way they once were, whether you're talking about the network television, or whether you're talking about ESPN, or whether you're talking about the movie business.
Yeah, I think sports is still very core to Disney. I mean, they are. So if you just kind of look at the US sports landscape, ESPN actually owns majority of the marquee US sports rights. Almost about 40% of all sports viewing happens on ESPN platforms. So obviously it's still very core to the company. As far as Jimmy Pitaro is concerned, Scarlett, I mean, yes, he was one of the, candidates that they were considering to take on this job. But I think he himself had many times indicated that he was not really interested in the top spot. I think he kind of carries on business as usual. With ESPN, it's a little bit of a wait and watch what exactly happens with the strategy. It is really instrumental, I think, to their streaming business because, as they kind of mentioned on their earnings call, a lot of people taking the bundle, the ESPN streaming plus the Disney plus the Hulu. So it is a critical portion of that. So I'm not really sure how exactly a spin out would work. But of course, again, we are in a very, very different time and age, and everybody is thinking about all possible options when it comes to media.
Our thanks to Geetha Ranganathan. She is our U.S. media analyst.
We move to some news in the energy space.
And this week, the German energy company Siemens Energy announced it will invest $1 billion in manufacturing capacity in the U.S. over the next 2 years as power demand surges.
The company said most of the funds will be spent on expanding existing sites in North Carolina, Florida, Texas, Alabama, and New York, as well as a new plant in Mississippi.
We are joined by Siemens Energy CEO Kunjan Sobhani.
We first asked Kunjan what the goal of the Siemens Energy investment is.
First of all, obviously, it's a goal to keep up with the fantastic growth which we see currently in the electricity market. And, gas turbines, grid, making sure that the AI transformation can really be fueled with electricity is one of the hottest markets you can see globally at the moment. And we are obviously trying to keep up with our customers, and we're trying to bring all this equipment what is needed, gas turbine, transformers and the likes. This means we are expanding a lot of our industrial footprint here. We are hiring people, adding factories to keep up with that. And this is obviously one important step really to create also this energy dominance, what the US is looking for.
You recently met with President Trump. What was the takeaway from your meeting there? How related is that meeting to your announcement in the investments in the U.S.?
Well, there was a, reception in Davos, right, which was a big group meeting. Yep. So what for me is important that the Trump administration is very approachable for us. And I have to say, I'm very grateful for that. At the moment, my key interactions is really with the secretaries in terms of really understanding, hey, what needs to be done? How do we need looking forward on the opportunities? And this is taken up excellently. At the moment, that is my main interaction also with the Trump administration.
Kunjan, how would you characterize the U.S. energy grid here as you get set to increase your investment here?
Yeah, first of all, what you see, the US market on the grid side is influenced by two things. The one thing is that you have a massive investment wave ongoing just for replacement, refurbishment of existing facilities. This is very much a utility-driven business, which is very active, which sometimes gets overlooked seeing the data center discussion. And at the same time, you obviously have an unprecedented growth in electricity on the data center side, which does require heavy investments into the grid side as well. And we need to understand also how do we operate all the things. I mean, everybody easily talks about gigawatts of additional electricity. There's not so many sites today in the US which like a 1 gigawatt type of consumption. This will require grid stabilization. And this is what we are trying to contribute. So what we are doing here is building factories for switchgear, transformers, components which supply to that industry, and obviously also bringing up people who can help to do this overarching design on the grid side. We believe that is let's say, really a long run, and we will see it for a long time because electricity grid is an important backbone of the critical infrastructure. And this is why I feel very comfortable with the investment we're doing, and I'm very happy with the market here.
So I want to pick up on where you just left off, bringing in more people to design some of the grid work there. Talk to us about jobs. How many jobs will your initiatives create? What kinds of jobs are they going to be? What level, what kind of education is needed? How much training will there be in order for you to find the right people for those jobs? Yeah,
right. I mean, we had today an organization with around 12,000 people in the US, right? And we're going to add another 1,500 on top of that. And this will be accompanied by a lot of education and training programs. A lot of this will be blue-collar working jobs also in the factories, making sure that we can produce, and also that we have people going out in the fields and fixing things. So this will go through training academies, which we build up in parallel in this. We have one big new facility coming up in Jackson, Mississippi, which will obviously also will be with one training center. We have a big site in Charlotte, which we also will increase on that. At the same time, building up factories is also then coming with some engineering work on the white collar side. So it will be both. But the big thing, and this is why we went out, is really, hey, this is I would call it a blue collar wave now, really, in terms of really getting educated workers. That is my biggest constraint at the moment also in the market. And it goes down to the construction workers, really people in the factories. And we should never, ever underestimate the need to finally get something done. And that will require more people, more skilled labor. And we will definitely contribute to that and to help to build up that workforce.
Our thanks to Siemens Energy CEO Kunjan Sobhani. Coming up, a look at why obesity data from drug maker Pfizer underwhelmed investors.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move to some news in the biotech sector.
This week, shares of Pfizer fell after the drug maker revealed limited data from one of its new obesity treatments.
It showed people lost up to 12.3% of their body weight compared to those on a placebo at 28 weeks.
And of course, this comes after Pfizer battled to buy weight loss startup Metsera late last year, with no new drug approvals expected this year. And the limited data released means the prospects for Metsera's farthest along drug do remain unclear.
For more on this and the latest in the biotech sector, we heard from Sam Fazeli, Bloomberg Intelligence, Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
We began by asking Sam about how investors were impacted by this limited obesity data.
Yeah. So look, they paid $10.1 billion for this. And is it all to do with that, or is it people being reminded again that the next 3-4 years, there's a major headwind from generic drugs coming for some of their key products on the market, Ibrance, Xtandi, etc. So that's partly the issue. And in order to deal with that, you need assets and drugs that are going to try and hopefully fill the gap. And maybe this is the problem with the data. The thing is, we've looked at the data. As you know, we have very deep obesity analysis. We've looked at the data, and it's not terrible. But as I said the other day when Roche reported some numbers, I think folks are getting over this percentage here, percentage there. You can only disappoint going forward. You can't, unless you give out somebody like 30-40% weight loss, which of course nobody wants. So this is getting to a point where now it comes to the nuance. And unfortunately, we don't have a lot of the nuance that we need to know about this data set. Tolerability. And it is good because it's a once monthly injection after the first few weeks. So it's well set up. But the market obviously doesn't like it because they're not getting enough information about how good actually it is.
Sam, it seems like if you want to be an investor in big cap pharma, you really have to be a stock picker. I've got stocks like Pfizer and Bristol on a trailing 12-month basis that are down, but I've got stocks like Johnson & Johnson and Eli Lilly and AbbVie. They're up big. And is that just because they've got the right portfolio of drugs and the others don't?
Entirely about that. What you don't want is looking into the abyss of generic drugs coming for your big earners with no obvious pipeline versus, let's take a Johnson & Johnson in this case. They have a phenomenal set of drugs for the multiple myeloma space or a whole, other oncology spaces. This is a powerhouse. And of course, they've also still got the other divisions, medical devices, growing quite nicely. So, and no massive, there's one that's coming up, a big hole that's coming in terms of generics, but they've still got these things that are growing at phenomenal speed. And one of their drugs, Darzalex, is very close to $20 billion. And that's just one indication in multiple myeloma. So they've done everything right in that case, and that's what the market likes.
So in other words, Sam, this is something that can be managed. The fact that Pfizer hasn't managed this well raises a lot of questions here because it's not like just one day they woke up and, there's suddenly a lot of competition for some of their best-selling drugs, or people are no longer paying up for COVID treatments, COVID vaccines. In terms of management, do investors need to question whether Pfizer has the right management in place?
Yeah, look, this is a tough game, right? Not a game, of course, but this is a very tough set of issues to deal with. Creating pipeline takes a lot of effort. Let's take Eli Lilly. For years, nobody was paying too much attention to their potential margin expansion that was coming. And they were arguing for it, etc. Maybe they were lucky they hit on these obesity drugs. Look at AstraZeneca. It took quite a lot of pain for Pascal Soriot to right that ship when he took it. So management's part of it. Then you need to be lucky. You cannot have just one or the other. And pipeline, we'll see what Pfizer shows us. Over time, they have assets that are in early development that we need to start seeing bear fruit.
Our thanks to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
We move to some news in the tech space. This week, Advanced Micro Devices suffered its worst stock decline in almost 9 years after its sales forecast underwhelmed investors. It's a sign that AMD is not making the AI inroads that Wall Street had anticipated.
Separately, the semiconductor manufacturers Texas Instruments reached an agreement to buy the U.S. chip firm Silicon Laboratories for about $7.5 billion.
This deepens TI's exposure to several long-standing markets for chips, including the home appliance, power, industrial, and medical device sectors.
For more on all of this, guest host John Tucker and I were joined by Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst.
We began by asking Kunjan if investors overreacted or if there is actually something fundamentally wrong with AMD's latest report.
There was nothing fundamentally wrong in this report. There were a lot of good things to take away, but it comes down to, when you become an AI darling, you set up really, really high expectations. And when you take out the China revenue, which was not included in the guidance and the expectations, the beat came out pretty modest, which I guess people didn't like and was not at par against the really high expectations that you have now every quarter from these companies.
Like they used to ask in the old Westerns, is there room enough for the two of us in this town? Is there room enough for them and NVIDIA?
There is right now. Look, the tide is lifting all boats. There is so much demand for accelerator chips that there's room for AMD as a GPU provider. There's even room for other folks like Broadcom and Marvell as an ASIC provider. So there's plenty of demand right now.
Do we like management? Lisa Su, I think, is just whenever I just see her interview, she seems super on top of it.
Yeah, like I said, fundamentally, nothing changed there. Their CPU story continues to become stronger. Nobody's paying attention to it right now because all the focus is on GPU and competing with NVIDIA. But people are forgetting inherently, when you look at 2 years back, this was really a CPU company. Their GPU storyline remains intact. We didn't expect any fireworks coming into this earnings. We don't expect it until really 4Q of 2026. So the market is aware of this. We really have to wait until the 4Q 2026. This is when they will be really put to test if they can really execute their first server level solution or not. So there's nothing changed that we saw should really concern us.
And how important is China in all this? I thought the export restrictions were lifted. I mean, what's taking so long?
Well, the export restrictions are different for each chip. So the MI308, which they were able to ship, had already licenses approved prior. So that's a different chip. The newer chips that now is in the news when it comes to NVIDIA is their H200s, and equivalent it will be the MI325. Licenses for those have not been granted yet, even though the White House has said that yes, these companies can start shipping these products yet. The formal licenses have not been granted.
Kunjan, some M&A in your space. Texas Instruments has reached an agreement to buy Silicon Laboratories for about $7.5 billion here. What's going on here with TI?
Yeah, so just to give some context, this is sort of this size of the deal they have not done in the past. The last time they did a deal like this was buying National for about $6-7 billion in 2011. So this is not their typical nature. So a bit of a surprise. Strategically, it fits well. Their industrial segment, which is their largest segment, and that's where they want to be focused, has a missing piece when it comes to wireless connectivity in IoT. So Silicon Lab gives them that portfolio. Financially, however, it's a lot more important. They have reiterated that this does not change their free cash flow trajectory. This does not change their dividend path. And this does not increase. The most important thing is the CapEx. So all those things we really like. If they're able to execute to that, get the cost synergies, then this will be a really good deal for them. Also remember, TI has been on a spending spree for the last 3 to 5 years, building up a lot of capacity. So this will help bring more loading to their internal factories and bring more manufacturing internal to own TI and help with utilization.
Our thanks to Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst.
We move now to some news from fintech company PayPal.
This week, PayPal reported quarterly profit and revenue that missed analyst expectations. The company also said HP CEO Enrique Lores will take the top job from Alex Chriss, whose turnaround plan failed to meet targets.
Jamie Miller, who is the payments firm's chief financial and operating officer, will serve as interim CEO until Lores takes over on March 1st. Shares of PayPal tumbled as much as 19% after the news. It was the biggest drop in more than 4 years.
For more on this, I was joined by Diksha Gera, Bloomberg Intelligence global fintech and payments analyst. I first asked her to break down the latest news at PayPal.
Like two big headlines hit at once, missed 4Q expectations, and then announced a CEO change. So on the print side, adjusted EPS was about a 4% miss, and the revenue came in 1% lower. And I should highlight, this is like their first miss in 2 years. But I think the bigger issue is forward-looking. Branded checkout, which is the main core high-margin business for PayPal, that has slowed to 1% in the fourth quarter. And PayPal is also flagging an earnings decline for 2026. So those were the key forward-looking problem areas. And the CEO change definitely was a surprise. I mean, the guidance revision was driven by their investments in some of the merchant business that they're doing. But I think the market reaction goes beyond that. I think it goes more around some of the serious gaps that appear to have been discovered, especially with Apple Pay and all the product advancements that the competition has come through. And I think, lots to unpack there today.
So just give us a sense of the competitive landscape of the businesses that PayPal's in the financial technology and kind of where do they fit in? What are they maybe not doing right here?
So PayPal has two parts of the ecosystem. It works with the merchants where you see the PayPal button when you check out, and it works with the consumers through its app, the PayPal app and the Venmo app. What is very interesting is that management kept highlighting execution discipline and prioritization. But honestly, like that is the main game. PayPal's biggest value add is the two-sided network. They could not have afforded to either drop the merchant or forget about the consumer. So it's been like it's a very competitive landscape. You have Stripe, Adyen, Apple Pay, as you would have noticed recently. Yep. They revised their partnership they moved from Goldman's to JP Morgan. So everyone is charging full stead, and PayPal needs to show up in that. And I thought they were getting there, but I think this new CEO change definitely puts a multi-year transformation back in the play now.
So what do you think is the next step for this company here? I mean, can it kind of remain competitive in this business going forward? Does it need to think about a new structure or a new strategy? What do you think needs to happen here?
Yeah, that's the million-dollar question, Paul. I think so. There are two things. One is I think investors really need clarity now on how PayPal reaccelerates its core checkout business. Is it conversion? Is it pricing, merchant value proposition? Because that's still the core engine. But I think secondly is whether the new leadership really signals a broader strategic shakeup. Like, do they streamline initiatives? Are they going to step up cost discipline or capital return? Or if it doesn't work out, maybe they'd consider like big assets like Venmo, strategically if the performance doesn't inflect from that.
Our thanks to Diksha Gera, Bloomberg Intelligence Global FinTech and Payments Analyst. Coming up, a look at why the food and beverage company PepsiCo is cutting prices by up to 15% for some key brands.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence through BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to some news in the food and beverage space.
This week, PepsiCo announced it is cutting prices by up to 15% for key brands, including Lay's and Doritos. It's a bid to lift sales by offering more affordable products.
PepsiCo has struggled to grow its sales in North America in recent years. The company, like many of its peers in the food space, raised prices during the pandemic and its aftermath to offset high inflation.
So we brought in Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst.
We first asked Ken for his take on Pepsi's earnings.
I think the broad takeaway for investors is that PepsiCo is committed to bringing better focus to this company. I've covered this company a long time, and its primary competitors, Coca-Cola, Keurig Dr. Pepper, you could say Primo Water, Monster. How they differ from PepsiCo is they're much more focused, particularly on specific categories. But PepsiCo, with the urging of the activists, urging them on, is bringing more focus to this company. And what I mean is they're rationalizing a lot of the SKUs that really aren't contributing much. They're consolidating plants. They are bringing more rationality to the trade spending. So when I hear things like, cutting price, that's tactical. That's just a way to, move the needle a little bit with near-term sales. But I think the bigger picture is to bringing more focus to this enterprise.
Right. I mean, investors are excited about its strategy as opposed to just kind of moving forward with the way it's always been. When it comes to those price cuts, though, I wonder if this is going to spark any kind of price war. Will other snack makers feel the pressure to also reduce prices, even if they've gone up quite a bit since the pandemic?
That's possible, Scarlet. In the case of Frito-Lay, though, they have such a dominant market share. They have like 60% of the market in the measured channels. And when you have that much of a share, you deserve a premium, particularly with PepsiCo's direct store delivery system. What that means is that they help their retailers much more than a lot of their competitors. And that is, they actually go to the store. They're quick to respond to out of stocks. They help position the product. They create the end caps in the store. They do a lot more for the retailer than their competitors. And so that's how they are helped to get premium pricing. So yes, they're rolling back some prices. I thought it's no secret that price increases have been up quite a bit since the pandemic. A lot of it's cost driven. And private label has encroached a little bit on PepsiCo's share. But to answer your question directly, they are the dominant player. I would not expect them to give back too much over time. And while their competitors may cut prices as well, I think retail would be alienating consumers if they push too hard on PepsiCo's price increases down the road.
Ken, talk to us about Elliott Management. They've been in this company. They've owned this stock here, pushing for some change. How much of an impact are they having?
I think on the margin, there's an impact, Paul, maybe to the degree that PepsiCo is hastening its move to more focus. A lot of the things that it's been doing all along, and that is upgrading their portfolio with more functionality. This is some of the things we talked about in the past. They're bringing more protein to their mix. They're bringing more protein by restaging muscle milk. So bringing more value to the beverages. So they've always been doing that. But to your question, Elliott is pushing them to do things like, okay, you can still do that, but also cut costs a little more aggressively. Maybe you don't need all these plants. Maybe you can consolidate some. Maybe there's some SKUs, some products that aren't selling well. You can roll those back. Be a little more nimble when it comes to getting rid of some products that aren't winners. Because at the end of the day, you have to grab as much shelf space at the retailer as possible. And when you have products on the shelf that aren't moving, you're not helping them, with their business. So be a little more aggressive with that. So it's helping. And I think that's a positive thing for shareholders.
Is this a company that's going to have to separate its drinks business from its snack business?
Well, that's the age-old question we've been talking about for a while. And as I mentioned, if it can prove to the market that this increased focus that they have with just doing their daily business or running these operations, if they can improve them, I think the heat will be off for them to go to the draconian measure of breaking up food and beverages. That's always the wild card, I think, down the road. And I think it'll be well received by the market, quite frankly. But I don't think it's necessary at this point.
What are your consumer products companies telling you, Ken, about just the consumer out there?
Well, Altria just the other day, it's a different market with cigarettes. They noted that consumers are still hesitant in paying up for premium products. Now, cigarettes, as I mentioned, isn't the same category as salty snacks, but they do note that consumers are reaching for the private label, the low-priced alternative, more than they've done in the past. And so to the extent that carries over to snacks and beverages, I can see some parallel lines here. And as more companies release their numbers, I think that could be a common theme here, that private label is encroaching, and maybe there needs to be some more deceleration in the reliance on price increases to stimulate sales growth.
That was Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst.
We move next to research Bloomberg Intelligence recently put out on global communications and networking equipment.
According to BI, the global networking sector heads into 2026 with multiple spending tailwinds led by cloud AI infrastructure buildouts. And the money spent on networking gear is expected to grow 20%, according to the 650 Group.
For more, I was joined by Woo-Jin Ho, Bloomberg Intelligence Senior Hardware Networking Analyst. I first asked Wooch to talk about how investors are now looking at AI.
It's fairly straightforward, right? It's a fairly concentrated space. The AI networking space is expected to grow 91% on the switching hardware alone to $21 billion, right? The way to play it is fairly straightforward. It's 3 C's, an A, and an N, right? That's my new networking FANG. Cisco, Celestica, Corning, and Ciena, so 4 C's, Arista, and NVIDIA, right? And those are going to be the leading beneficiaries for the networking space in AI.
So give us a sense of kind of how investors should think about the investment cycle for AI. I'm going to say we're 2-3 years into it. I'm just not sure. How do you guys think about the duration here?
Yeah, it's quite odd, right? Because, some of us say it's 2-3 years into it. Michael Dell had this interesting quote a couple of weeks ago saying, what inning are we? And his response was, we're just entering the stadium.
Wow.
Right?
Yep.
He still thinks it's early on in terms of the investment phase, and networking is going to be one of the leading beneficiaries of it.
So how are the networking equipment companies that you follow, how are they financing some of their CapEx? Because again, I think most of us grew up when technology companies had so much cash flow that they could self-fund their R&D, their CapEx, that type of stuff. Now many of them need to come to the capital markets.
Yeah, fortunate for the networking guys, it's a low capex type of business, right? We're talking about sub 10% of the cash flow to capex, or 10% capex ratio to sales. So it is a fairly self-funded business, and it's also high margin business as well. As long as the hyperscale cloud providers, as well as the tier 2 cloud providers like the neo clouds are funded, they'll be able to buy the networking gear.
So how do you, it's interesting here, you think about the tech space and its hardware, its software, it's the networking equipment here. Who's kind of driving this AI thing? Are your networking and communications companies, are they kind of dependent upon, what the hyperscalers are doing or what the chip makers are doing? Who's kind of leading this?
So at the end of the day, it's how quickly and how fast and how large of the investments that the hyperscalers are making on the AI side. I will tell you, as these language models grow and the scale of these compute investments grow, you actually need a lot more networking. And networking is, if you think about it as the arteries and the veins of a human body, networking is probably at the center of that right now. And that's why you're having a lot of investment on the networking front.
How are they dealing with, again, these networking companies? I think of these big global companies. Is the manufacturing dispersed around the globe? Is there a pressure to bring it to the U.S.? How are they dealing with some of the changes we've seen in global logistics, whether it's tariffs or just most favored nation status, those types of things?
Yep, no, that's a fantastic question, Paul. I will tell you, there's a couple of things, right? When we had the tariff situation, number one, and also the COVID situation a few years back, the companies have actually done a good job rearranging the supply chain. A lot of manufacturing is happening out of Mexico. There's some manufacturing that's happening in Taiwan as well as in Canada. So we're bypassing some of the tariff situation, and quite frankly, tariffs have become a non-story for the majority of my networking guys. And on top of that, the DRAM story is inconsequential for the networking names as well.
How are the stocks performing here? We've seen so many parts of the tech space just rip. How have your stocks been doing?
I will tell you, if you looked at the Celestica 2 years back, you're seeing a 10-time performer to where it is right now. It has slowed down because I think people are starting to catch up to the name. Arista, it's a double from 2 to 3 years back. And Cisco, I mean, we've finally got back to its 2001 highs because the business has actually stabilized. Yeah, so the stocks in itself have done well. The multiples have actually gotten a little bit rich.
That was Woo-Jin Ho, our senior hardware and networking analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.